In the last 48 hours of trading, silver moved in a way that breaks most people's mental model of what a stable, deep, liquid market is supposed to look like. Not months, not weeks, 48 hours. The kind of compressed volatility that turns a calm commodity into a stress test for balance sheets. And while the public conversation stayed fixated on the price flashing triple digits, an entirely different conversation was taking place in the institutional layer, the plumbing, the positioning, the collateral, and the delivery mechanics that decide whether a move is just a chart event or something that starts cracking systems. Here's the part that should stop you. At the same time, silver was being treated like the next monetary escape hatch. One of the most widely circulated institutional warnings in the market was saying the opposite with almost surgical bluntness. A scenario where silver gets cut in half within a year, 50%. That contradiction is the story. Because when the top of the market is screaming one thing and the architecture underneath is preparing for another, it usually means the real battleground isn't sentiment, it's settlement. Now add the rumor layer. When traders hear words like emergency HUDDLE next to a major bank name, it spreads because it fits a pattern everyone recognizes. Big institutions don't call extra meetings because they reboard. They call them when exposures, liquidity, or operational constraints collide with price action. I'm not here to sell a conspiracy. I'm here to show you why the market would even generate that kind of chatter, and what the data says about the conditions that make it plausible. Welcome to Silver Signal Room, where we decode what matters before its headlines. Not by guessing the next candle, but by reading the footprints institutions leave behind. If you've been listening like that wise elder at the edge of the room, you already know the routine. Ignore the noise, follow the mechanics, and let me know where you're watching from, because this story is global, and the pressure points don't sit in one country. So what actually happened? First, silver's price regime shifted into a zone where headlines write themselves. Triple digits puts silver into a psychological category it rarely occupies. Even when silver is strong, it usually trades like a volatile cousin of gold, not like a runaway monetary asset. When it jumps into that zone, it pulls in two types of participants at once: momentum chasers who only see the chart, and risk managers who immediately start running what-if scenarios on collateral margin and forced liquidation. At the same time, gold didn't just drift higher. It punched into levels that force a rethink of what normal means. When gold moves that far, that fast, it doesn't stay contained. It drags the whole complex with it: silver, platinum, miners, rates, currency hedges, and the risk models that tie them together. That's where the abnormality starts. Because a lot of institutional positioning is built on spreads and relationships that assume metals move, but not like this. Then the central mystery appears. If silver is truly becoming scarce in the real world, why would serious institutional voices be publicly comfortable talking about a 50% drop? And if silver is truly just a speculative blow-off, why do the physical and industrial narratives keep returning year after year to the same deficit language? This is not opinion, this is pattern. When two high-confidence stories collide, the market usually resolves it by forcing one side to learn what the other side already knew. To see it, you have to zoom out. Silver has done this before, and it always follows a familiar playbook. In 1980, silver didn't just rise. It went vertical into a frenzy where the difference between price and availability became political. The result was not a gentle fade. It was rule changes, margin pressure, forced deleveraging, and a collapse that punished anyone who confused a squeeze with a permanent revaluation. In 2011, silver ran again. Different era, same psychology. The narrative was monetary debasement, the chart was a rocket, and then the market's infrastructure did what it always does when leverage gets too comfortable. It tightened. Margin requirements climbed, financing costs rose, and the weakest hands were forced out at the worst time. The result was a sharp reversal that didn't need a villain, it needed only mechanics. And now, in 2026, the ingredients rhyme. A high-speed move that attracts leverage, a public narrative about scarcity and monetary stress, and, crucially, a system where silver can mean two different things depending on where you stand. A futures contract that settles in cash most of the time, or a physical bar in a vault that has to be located, assayed, allocated, and moved. The most important line in this story is that the market can be in deficit and still experience a violent price drop. That sounds like a contradiction until you understand the difference between structural tightness and cyclical liquidation. A deficit describes the long arc of supply and demand. A price crash can be triggered by positioning, margin, and liquidity in the short arc. When those arcs collide, the short arc often wins first. Then the long arc reasserts itself later, sometimes at a much higher level, sometimes after a long, punishing reset. So who are the players and what are they doing? Start with the banks and dealers who make markets and finance positions. They don't have the luxury of believing a story. They have to manage exposure. When volatility spikes, their risk limits get hit, their clients get margin calls, and their own hedges have to be adjusted. That's when internal meetings multiply. Then look at the exchanges and clearinghouses. They are the quiet governors of leverage. When prices move too far, too fast, they change the cost of carrying risk. They do it through margin, haircuts, and settlement rules. This is not a moral judgment. It's the system protecting itself. But for traders, it can feel like the ground shifting under their feet. Now bring in the regulators and the reporting architecture. A lot of the public sees a price and assumes it's the whole story. Institutions see a price and immediately ask, what's the open interest? What's the concentration? What's the delivery schedule? What's happening to deliverable inventory? What's the cost of borrowing metal? What's the spread between locations? What's the premium for coins and bars? What's the flow from west to east? These are the questions that decide whether a move has staying power. Here's where it gets interesting. Silver's industrial demand isn't a niche anymore. It's a pillar. Solar, electronics, electrification, and advanced manufacturing have turned silver into a strategic input. And the numbers being discussed in serious market reports are not small. 5 million ounces. That matters because it makes silver different from a purely monetary metal. It means the economy consumes it, not just hoards it. At the same time, the deficit narrative keeps repeating multiple consecutive years where total demand outstrips total supply by a large margin, including a widely repeated deficit figure around 95 million ounces for a recent year. If you only hear that, you might assume price can only go up. But the market is more complex because demand includes investment flows that can reverse quickly, and supply includes recycling, and above-ground stocks that can be mobilized when price incentivizes it. A deficit can coexist with volatility. So let's talk about the dislocation, because this is where the story becomes real. One side of the market is the paper world. Futures, options, swaps, and leverage products that can represent enormous amounts of silver exposure without moving a single bar. The other side is the physical world. Bars and vaults, coins, industrial contracts, and supply chains that have lead times and friction. When the paper world gets excited, it can bid the price up faster than the physical world can respond. When the paper world gets scared, it can slam the price down faster than the physical world can suddenly produce more metal. That's why you can see a chart that looks like a waterfall while physical premiums remain stubborn, or inventories move in ways that don't match the price narrative. There are also geographic dislocations. The West often trades silver as a financial asset, a line item, a hedge. The East often treats it as a tangible store of value and an industrial necessity. When stress rises, metal can flow, and the price that clears in one venue may not reflect the ease of obtaining metal in another. Now, proof with numbers, because this can't stay abstract. Consider the concept that gets whispered whenever markets get tight: the ratio of paper claims to physical availability. You'll hear different estimates depending on the methodology, but the underlying idea is consistent. A modern bullion market is built on netting and confidence. Most claims are settled financially. The system works as long as only a minority wants delivery at the same time. When that minority grows, the system doesn't necessarily break in a dramatic sense. It adjusts. The price of certainty rises, and the cost of leverage rises with it. Another tangible proof is vault reporting. Major vault systems can hold enormous tonnage of silver, with figures discussed around 23,191 tons in a London system at one point, translating into hundreds of thousands of large bars. That sounds like abundance until you realize not all vaulted silver is the same. Some is allocated to specific owners, some is pledged. Some is in forms not immediately deliverable to a particular contract. Some is simply not for sale. And then there's the delivery calendar itself. Futures markets have months where delivery matters more, and moments where issuance and stopping activity reveals who is taking what. Even a single snapshot can be revealing. A day where a couple hundred contracts change hands through issuance and stopping is not, by itself, proof of a crisis. The signal is whether the same participants repeatedly show up as receivers, and whether that lines up with other strains like premiums, spreads, and financing. Let me make the mechanism simple, because this is where most commentary gets lost. Think of the silver market like a highway system with two kinds of vehicles. One kind is a lightweight scooter, paper contracts that can change hands 1,000 times without ever touching a warehouse door. The other kind is an 18-wheeler, physical bars that have to be located, inspected, scheduled, insured, and hauled. When traffic is normal, scooters and trucks share the same lanes and the same speed limits. But when a storm hits, scooters can still swerve instantly. Trucks can't. The chart can move faster than the metal. Now layer leverage on top. Futures and options are designed to let participants control large exposure with a smaller amount of collateral. That works beautifully when volatility is modest. But when volatility expands, the collateral required to hold the same position rises, and it can rise faster than people expect. If margin requirements jump, or if brokers increase house margin, a trader can be forced to reduce exposure regardless of their conviction. That selling pressure is mechanical. It doesn't require anyone to change their mind about the long-term story. This is why the phrase, "they changed the rules," shows up in every major squeeze or blow-off. In reality, the rules were always there. They just didn't matter until volatility made them matter. Exchanges exist to keep the clearing system functioning. When a market moves into extremes, the clearing system demands more buffer. The buffer comes from margin. The moment margin rises, weak balance sheets become sellers. Here's another dynamic that gets missed: the dealer hedge loop. Many large participants don't hold naked directional risk. They hold portfolios. When clients pile into calls, dealers often hedge by buying futures. When the market reverses and those options lose sensitivity, dealers sell futures. That flow can accelerate both up moves and down moves, creating a self-reinforcing surge that looks like mystery buying on the way up and sudden collapse on the way down. It's not mysterious. It's the structure of the market responding to positioning. Now bring in the deficit math that keeps getting repeated. A 95 million ounce annual deficit sounds like a single, clean number. But what it really means is that, over a year, net demand exceeded net supply by roughly the equivalent of several large vaults worth of metal. That gap has to be filled somehow, by drawing down above-ground stocks, by increased recycling, by shifting inventories from one location to another, or by suppressing demand through higher prices. Each solution has friction. Each solution has time. And friction plus time is exactly what markets punish when they get impatient. Industrial demand adds a second layer of tension. 5 million ounces. It implies a baseline pull that doesn't disappear just because the chart turns red for a month. Manufacturers can delay, substitute, or thrift, but those changes are slower and often costly. It's steady until it hits a threshold, then it adjusts. Markets hate thresholds because they create nonlinear moves. This is where the paper-to-physical concept becomes more than a slogan. Imagine a theater with 1,000 seats. Now imagine it sold 6,800 tickets, because most people never show up at the same time, and the venue refunds or reschedules. That can work for years. But if a popular event happens and a higher percentage of ticket holders decide they want a seat on that night, the mismatch becomes visible. Markets solve that mismatch in predictable ways. The price of certainty rises, rules get tightened, and some claims get settled in cash instead of a seat. So why would an institutional voice be comfortable talking about a 50% downside while the deficit story persists? Because institutions are often talking about different time horizons. A warning about a sharp drop is usually a warning about positioning risk and valuation extremes, not a denial that the metal is important. A market can be structurally tight and still be temporarily overpriced relative to its own history, especially if speculative demand arrives faster than supply can respond. In that case, the flush can be brutal, and the long-term story can still be unresolved. This is the contradiction that makes the HUDDLE narrative believable at a psychological level. If you're running risk at scale, your nightmare is not that price goes up or down. Your nightmare is that price goes up and down in a way that triggers correlated failures: margin calls, liquidity drains, client defaults, and operational bottlenecks. Volatility is the enemy of fragile balance sheets. The bigger the move, the more meetings happen. There's also an old silver-specific tension that returns in every cycle. Silver is a smaller market than gold, yet it often carries larger emotions. Its price is lower in absolute terms, which invites retail participation. Its volatility is higher, which invites leverage. Its industrial role is real, which invites fundamental narratives. And its history includes famous squeezes and collapses, which invites myth. Put that together, and you get a market that can swing between it's just a commodity and it's the next monetary event in a single season. If you want to see how coordination can look without anyone needing to whisper in a dark room, watch timing. When volatility spikes, multiple institutions independently do the same things at roughly the same time because they are responding to the same incentives. Brokers raise margin, exchanges adjust risk parameters, dealers widen spreads, inventory managers become more conservative, refiners quote longer lead times. So what does all this mean going forward? Historically, when you see a sharp volatility spike, a loud scarcity narrative, and evidence of structural tightness, the next phase often comes in one of three forms. The conservative scenario is a violent normalization. Price retreats sharply as leverage gets forced out, margin costs rise, and speculative froth burns off. In that scenario, the narrative shifts from shortage to bubble, and most people conclude the whole thing was a mirage, but the structural story can remain intact underneath. The moderate scenario is a two-step, a hard flush followed by stabilization at a higher plateau than the old regime. That's the market digesting the new information. It shakes out weak hands, then reprices the metal based on tighter conditions, higher costs, and continued industrial pull. The aggressive scenario is a genuine repricing of access. Not just price up, but terms change. Higher premiums, wider spreads, more persistent tightness near delivery, or increased emphasis on allocation and custody. That doesn't require a dramatic failure. It requires enough stress that participants decide certainty is worth paying for. Notice the language. These are not predictions. They are historical behaviors that show up when certain ingredients appear together. So what should be watched? Not the loudest influencer, not the cleanest chart pattern. Watch the indicators that institutions watch because they have to. Watch how margin and financing terms change when volatility spikes. Watch whether spreads between locations widen or snap back. Watch whether physical premiums detach from futures. Watch whether deliverable categories of inventory trend persistently lower. Watch whether delivery demand concentrates in a few hands. Watch whether industrial buyers start locking in supply with longer contracts, signaling concern about availability. And now we come to the divide. The divide is not between optimists and pessimists. It's between people who think markets are stories and people who know markets are systems. The story can be whatever it needs to be. The system has constraints. Those who understand the mechanics don't need to be the smartest in the room. They just need to be the most attentive. They notice when paper and physical stop agreeing. They notice when volatility forces rule changes. They notice when public narratives become extreme in both directions at the same time. And they recognize the oldest truth in markets. Institutions move first, and the crowd explains later. If you've been wondering why a rumor like an emergency huddle could spread, this is why. When the metal is moving fast, the leverage is high, and the settlement system is built on confidence, every major dealer has to run the same playbook. Check exposures, check collateral, check client risk, check liquidity, check operational readiness. That's not drama, that's survival. This is the moment to remember what the metal is revealing. Not a prophecy, not a slogan, a set of constraints. When the paper layer moves faster than the physical layer, volatility becomes the translator, and institutions respond before the public even agrees on the question. If the next days bring higher margins, wider spreads, or unusual delivery behavior, that won't be drama. That will be the system rebalancing itself. This is Silver Signal Room, where we decode what matters before its headlines. If this helped you see the gears instead of the noise, you know what to do. The question isn't whether Silver's story keeps evolving. The question is whether you'll recognize the pattern while it's still just data.